Well, we see little upside to the Indian market irrespective of these three scenarios. And let me try and talk about why. First, let's see about what the market really wants. The market would like to have a stable government in power. And the argument being that if you have a government that has visibility for 5 years with fewer coalition partners and fewer compromises to make, then at least for policy formation can be more conducive. The second thing that the market wants, I think, is that you have more investments over distribution. Okay. Because from a market point of view, more roads, more infrastructure is what is good for long-term growth. Distribution probably does not act to growth capacity. Given the math that we have on pre-poll alliances and what everybody is forecasting, it seems that a non-BJP government would have far more partners in coalition and may therefore have too many compromises to make. Which is why the base case, it seems, for everybody is that BJP comes back to power. Or at least that was the market seems to be expecting. If the BJP or the NDA were to come to power on May 23rd, on May 24th, we'll all be asking ourselves what next. Because the market has rallied relatively hard into this expectation, we will suddenly find ourselves that nothing really has changed on the ground. Because even if you look at the BJP's manifesto, they are not promising any major radical change once they get back to power. If, for example, you got a more fractious coalition in power, that will be a disappointment for the market anyway. So again, in either of these outcomes, we don't see major material further upside to the market. The only way that happens is if EM continues to rally. Because India is joined at the hip to EM. And if that continues to move up, then we will keep to get our proportionate inflows. See, mathematically, it should happen because the largest sector in indices in India, which is the financials, the banks, should be in a position to deliver much better earnings this year. This is principally on the back of lower provision costs. Demonstrably, the NPA cycle for Indian banks is over. Most banks have not been booking very large NPAs. Provisions should be coming off. However, this is difficult to pinpoint because much of the provisioning depends upon management strategy at individual banks as well. A certain bank may make the choice to aggressively reduce net NPAs by keeping provisions high. Another bank may choose to spread it out over some time. So while yes, it seems that the banks should deliver better earnings, the exact magnitude of that is a little bit difficult to pinpoint. We are overweight financials because the top-down argument makes sense. Loan growth is coming back, especially because the competition from the corporate bond market or NBFCs is reducing. The NPA cycle seems to over, so the investors' concerns on the balance sheets of these banks seem to be behind us as well. And many banks have sorted out capital issues or management concerns that were there for some time. The only concern that I suspect we have now in financials is that many of them are now above their own average multiples. But at least from a growth in operational momentum, they still seem to be favorably placed. We are underweight resist spaces like telecom in India, which sees continued competitive intensity. We are underweight materials and energy, which are global commodities.